Welcome, everyone. My name is Adrian Leeds with the Adrian Leeds Group, and I want to welcome you to the North American Expats in France Quarterly Financial Forum. This is first quarter 2025. And we have a big topic today. We're going to talk about the U.S.-France tax treaty, which, as far as Jonathan Hadida says, is the best in the world. We're going to be with Brian Dunhill, who is the co-sponsor of this event. Brian, you want to say hello?
Very nice to see you as always, Adrian.
And with Brian are two of his colleagues, Cédric Bernier, who is the director of the French office and a financial advisor, and he's in Biarritz, and Eric Frison, who's also with Dunhill, and he is currently in Antibes. I've got Patty Sadowskis with us, who's going to be monitoring the Q&A. So when you have questions to ask, please put them in the Q&A here on Zoom, and then we're going to address those questions at the end of the talk. Please keep them on topic. Please don't make them too personal, because we want everyone to benefit from the answers. And I think we're going to go ahead and get started with Brian. Yes?
Perfect. Yeah, absolutely. Well, I think Cédric and Erica have taught us that I need to pick where I'm living a little bit better, living in the sunshine parts of France. And if you don't know where those places are, you haven't read enough of Adrian's newsletters of the beautiful parts of France.
Patty and I are both in Nice at the moment, so not too far away from Eric.
Exactly. You guys have it all right. You guys have done everything right in that way. Today, as we build up to tax day, we're going to be talking to Jonathan Hadida, who is the tax extraordinaire on everything to do with American expat taxes for people living in France. Now, Jonathan, we were exchanging some emails, and I think we came up with the term that taxes are like mothers. They're often misunderstood, but they're never forgotten. So we'll keep that on topic, that we essentially need to make sure we don't forget any of the big exchanges. But you've also made the expression that the double taxation agreement between America and France is the bee's knees. And we were going to want to concentrate on that, all the great news and all of the things, but all of the aspects that we don't want to miss out on as American expats. So without further ado, I'd like to introduce Jonathan Hadida and pass it over to you.
Excellent. Thank you, Brian. Thank you, Adrian. I am super excited to be here tonight to talk to y'all about U.S. French taxes, because as Brian said, taxes may be like mothers, but my father used to say taxes are more like mother-in-laws. A pain in our a thorn in our side, and something that if we don't treat correctly, our wives will be upset at us. So, without further ado, here are our slides for tonight. We are going to talk about what you want to know. These are questions from actual clients that we are going to bring up and talk through today. We will start, as always, with a general introduction of myself, and then we'll get into our topic. So, my name is Jonathan Hadida. As Brian said, I am the founder of Hadida Tax Advisors. We are a small U.S. and French tax firm assisting Americans living in and around France. I am a lawyer by trade, but an accountant at heart. I like to say, because I am a member of the New York Bar, but have been doing U.S. taxes for coming up on 20 years now. So if you see the gray in my hair and the thinning in my hair, or if you've watched videos before and if you see that picture of that young man there who looks much more svelte, that was years ago, and I've been doing this for a little while.
A lawyer by trade and accountant by heart. Does that mean you're looking at my shoes instead of your own?
Absolutely, Brian. I always look at your shoes. I always pay attention to that.
And Jonathan, you're clean shaven too.
Adrian, you told me to look good, so I tried my best.
We like it. Yeah,
I tried my best. It happens every now and then. I come down to clean shave, but it does feel a bit weird to not have the beard, but alas, it's a good thing. So for tonight's conversation, we will start with the topic that we always start with, which is, am I a French tax resident? Because that is the first question people, when coming to France, want to know. Will I be a French tax resident? And when will I need to start filing taxes in France? Then, from there, how do I avoid double taxation in France? We'll then turn to investing in France and contributing to an IRA while still in France. And that will be our chance to have Cédric, Eric, and Brian regale us with various stories from the financial world and explain just why I like to say that the financial advisor is your best friend when in France. Because again, the most dangerous man or woman in France is a French banker. Right? So we'll talk about that. We'll then quickly just cover off ownership of a foreign corporation, because too often people come to us and say, hey, I just set up a French company. Cool, eh? We'll talk about why it's cool, but has some problems. We will talk about gifts and inheritance. What happens if you receive money from an American in France? What happens if you see it as an inheritance? We'll talk through that. And then last but not least, I unfortunately have left the bad news for the end. I probably should have sandwiched it, but no, I want to make sure that it is remembered. France does not trust trusts. So we will walk through why France doesn't trust trusts and why it is so important, if you have a trust, to reach out and speak to us before you come to France. Okay? So let's get started with tax residency. So the question we get, am I a French tax resident? Well, the answer is, and if you're playing a drinking game at home, every time I say it depends, you can take a glass of water and drink it, because I will be saying it depends a little, more than a little bit. So it depends. Okay. Now, the first question we always look at is we look at French internal law. And under French internal law, we look at where is your principal place of residence? Where is your principal place of abode? So where do you sit and have dinner with your wife and children every night? Where is your foyer principal? Okay. If you have a home in France, technically you're a French resident. If you have a job in France, you're a French resident. If your center of economic interest is in France, you're a French tax resident. Okay. Now, I had a question the other day. I just bought a house with Adrian Leeds in Nice. Does that mean I'm a French tax resident now? Adrian? Does it?
No.
There you go. No, it does not. It just
One has
means
nothing to do with the other, Jonathan, and you know it.
I know it, but I just wanted to make sure that you knew it.
Thank you.
But basically, that does not make you a tax resident. That just makes you smart. Because again, Nice is magnificent. And anyone who hasn't been to Nice will know that Nice is fantastic. So says Eric, so says Adrian, so says Patty. Brian was just, as Brian said, he's lamenting not being in Nice. Trust me, I'm lamenting it as well during our cold winters here in the Alps. So, if you're a French tax resident under French internal law, does that mean that you have to file a tax return? The answer is no, because we then turn our attention to the US-French tax treaty. And under the US-French tax treaty, we look at 4 questions, but the main one is the second one. The first one is, do you have a home in both countries? If the answer is yes, or a home available to you, sorry. If the answer is yes, we then turn to the second question, which is, where is your center of vital interests, economic and social interests? And each one is looked at just as importantly. So for example, Bob Smith comes to France to live near his daughter. Bob Smith has all his investments back in the States. However, Bob Smith's only daughter lives in France and Bob Smith comes to France. Well, it now may be a tie in terms of where his center of vital interests is. So we would then turn to the third criteria. Again, there's more to look into it than just that, but we would start at that point. We would then look at the third criteria, which is, where is your habitual place of abode? Okay. And far too often people come and say, I'm spending less than 183 days in France, so therefore I'm not a French tax resident. Well, or I'm spending more than 183 days, so therefore I'm a resident. 183 days is just a factor, is one thing that we look at in the myriad of questions in looking at whether or not you're a resident, okay? And it's vitally important for you to understand that every case is different. Basically, as every individual is different, everybody's life is different, everybody's facts and circumstances are different, okay? So we need to just look in and say, okay, are you a resident? Are you not a resident? All right.
Good
Now,
question, Jonathan.
yes, Brian.
So in summation, it's where you lay your head, where you do your business. Those are the two things that are the two big criteria. But is it similar to the US where basically it's self-determined, or could you get a determination from the French authorities?
Thank you, Brian, for bringing that up. You hit on exactly what I was about to turn to. It is self-determined. However, the French authorities can come knocking. So if you come to France and spend 250 days every year in France, but have said, I'm not going to be a French tax resident, I've decided, I self-determined that my home is actually in Pittsburgh, Pennsylvania, and that's where it's going to stay. Well, the French authorities might not agree. And the way that the French authorities are going to find you, to be completely honest with you, in the new world, is AI, is technology. You may or may not have read that India, in their recent tax bill, has introduced a clause that the Indian government can look at your WhatsApp messages, could look at your Google Map messages to see where you are. So AI and technology will help the tax authorities find tax delinquent folks. We'll find people who are not being residents.
I have a question, Jonathan.
Yes, ma'am.
Okay. Not all, but most of our clients are basically retired, coming over on a visitor visa. Their pensions are not going to be taxed. Their Social Security is not going to be taxed. Their dividends are not going to be taxed. And therefore, they're going to have a zero on a tax return.
Yep.
Right? I mean, it's a zero. So does it really matter? I mean, aren't the French authorities just going to be wasting their time? And they're not going to be looking for these people, because why would they want to go in and audit people who have agreed to not work in France and aren't going to have any taxes to pay anyway?
There's not just income taxes, Adrian. There's inheritance taxes in France. There are gift taxes in France. There are real estate taxes in France. So whether you're a resident as a retiree, to be completely honest with you, in most of our clients' cases, it's not income tax that you need to worry about. It's the inheritance tax that you need to worry about. It's the trust rules that you need to worry about. So to answer Adrian's questions, yes, they care. Yes, they care that Daddy Warbucks has come to France to live in France and saying he's not a resident, because if Daddy Warbucks dies in France, they will want Daddy Warbucks to pay French inheritance.
Okay, but it's when he dies that it's a problem. I mean,
but Adrian,
okay.
if we all knew
that can be a big problem.
Sorry, Brian?
I just said that can be a big problem.
Be a big problem. I'm
just
just bringing in the reality of the situation. That's all. Okay, because in all practical purposes, I mean, until that person dies, then the French tax authorities don't have any claim on anything.
Potentially, but it would still not be the right move, because again, at the end of the day, they can come back and hit you with penalties. Again, there would probably be no penalties because you're not filing, but you should file. If you're a resident in France and you want to be kosher, because again, if you're going to turn around and try and renew your visa or go for the 10-year residency card or even citizenship, you need to show tax returns.
Well, that of course.
So
what I'm trying to do in this, asking this question is, we get a lot of questions from clients who just sort of like, they're really concerned about taxes. Okay, it's in the front of their minds, and I'd like for them not to be quite so freaked out about it, at least the first or second year that they're here, so they can relax, get to know what's going on in France, and then deal with it without worrying the minute they arrive here whether they're tax resident or not. You see what I mean?
Adrian, let me tell you why they don't have to worry. Because Adrian, as you know, the French-US tax treaty, everyone, I've been walking in the streets of Paris. I was walking in the streets of Nice the other day, and I heard someone say, "This is really the bee's knees. How amazing." Everybody's saying it.
Is that how you fell and broke your hand?
Pretty much. I got blown over by the wind, and it basically, I started fighting against the floor, and the floor but basically, the US-French tax treaty is something that makes it that for US retirees, you should not worry about French taxes. You should come to France. You should, as Brian told us last year, you should go back and find, President Lyndon Johnson and Charles de Gaulle from 1967. Go lay a prayer at their tombs and say thank you very much for this magnificent piece of work, which allows you to come live in France and not pay French taxes on your US sourced investment income, pension income, rental income. Therefore, a US retiree who's coming to France, who spent their life in America, who's got their investments in US investments, who's got a pension, who's got a social security, who's got some rental properties in Pittsburgh, they will not pay any French income taxes on those monies. Therefore,
Okay, I got another question, which
Shoot.
was asked to me today, and that is if we are concerned about what Mr. Trump might do to this.
Adrian, I could be concerned about so many things. To be honest with you, my biggest problem was the floor. It broke my hand. But if I'm worried about everything, we cannot be concerned. At the end of the day, we don't know.
I mean,
it would
right.
It would take a lot. It would not be a good move for America to get rid of this US-French tax treaty. So honestly, I don't know. I don't believe anything will happen. It would require a major change in the US tax policy. I don't foresee it.
That's what I actually said.
In the last decade, we've only seen globally 4 double taxation treaties actually revoked. And the US only had to do with one of them, and that was to do with Hungary.
Hungary?
Yeah, with Hungary. Now, I'm going to get a little political, and then I'll come back. I'll rein myself in. Essentially, most of these policies that have to do with cross-border issues are Trump's attempts to muscle the dollar down, right? Now, whether he'll be successful or not, that's a real question for our. Sorry, it is really a question over the course of time. But at the end of the day, he doesn't want to actually make huge changes, especially with something that's not going to help in any way, shape, or form of restructuring any of the deficits that are going into that, i.e., it would actually not help him in any way, shape, or form to have individuals that are moving to France be taxed in France instead of in America.
No, that is true.
It won't come from the Trump administration, and I would actually guess that the Trump administration doesn't have a clue that this is the case.
That it even exists?
Exactly. So I would not be concerned about that. There's bigger concerns that we have in regards to the Trump administration at this point in time.
Okay, we'll put that to rest. Jonathan, you can continue now. Thank you.
Perfect. Now, in terms of residency, I'm just going to come back to residency to add one final point. So again, a lot of times people ask us, so I got asked this the other day. I moved to France on March 23rd or 26th of 2025. Does France care about anything that happens before I became a tax resident? Okay. And this is an important thing to remember. It's kind of like when you're young and you have a new girlfriend. Anything that happened with your girlfriend before she met you doesn't matter. You only care from the moment you started dating onwards. Well, France sees you like the new girlfriend or new boyfriend. They only care from the day you come onwards. Anything that happened before, that doesn't matter in life. It's from that day onwards that they will tax you and will look at your income. Okay. So
I understand why your girlfriend became your wife, Jonathan, with
oh
that
yeah,
statement.
no, absolutely. With quotes like that, how would you not want to marry me? Plus, come on, I do taxes. It's great. What woman doesn't want a tax guy who's losing his hair and getting fatter all the time? It's a good problem to have.
It's because you got that fancy new camera. It just adds 10 pounds.
Hey, plus I've got a Bob Smith t-shirt behind me, Expos jersey behind me, so it's a good thing. So let's talk about investing. We have a lot of investing guys here with us today. So now I'm going to stop talking for a little bit and I'm going to turn it over to Cédric Bernier. Now, for those of you who don't know Cédric, Cédric is from Quebec City. And as we all know, nobody in Quebec City ever lies or doesn't tell the truth, except if their names are Parizeau, Obu, or Marois, or anything like that.
Are these inside jokes? These are inside Canadian jokes.
If you
Is
understood that joke, yes.
You're from Quebec.
You're from Quebec.
So is this all in an attempt to make sure that we teach the entire audience how to pretend to be Canadian for the next 4 years?
Absolutely. Well, everyone, yeah.
Maybe.
So the questions that we get asked often is, how do I invest when I'm in France? And how do I do it in the most tax efficient manner? So, Cédric, PFICs.
Yes.
I'll let you talk about PFICs for a second. And basically, people, if you want to understand why Dunhill Financial, Cédric, Eric, why they all have jobs, PFICs. And the fact that they're very good at handling your money. So, Cédric, I'll turn it to you.
Yeah. Well, I'll share a little bit because I've been doing cross-border financial advice in France for the last 3 years. And that's one of the main things we see clients that move to France, open many different types of investment accounts with French bankers that probably try to do a good job, offering great, in tax deferred investments to their clients. But Assurance Vie is one of the main, type of accounts that we see with our clients. And for Americans, it's really difficult because it's taxable in the US. You have to report it when you file taxes in the US, and most people don't. So I would say, the investment inside of these French investments are going to be PFIC. They're going to be foreign mutual funds, most of them. And then that's going to be a big issue for a lot of our clients because they don't report it each year. You don't get a 1099 when you file taxes at the end of the year. You don't get the tax documents you need to file taxes in the US. So that's, really something that's a big issue for a lot of our clients in France.
So just to be clear, a passive foreign investment company, Cédric, is generally a foreign mutual fund or a foreign ETF.
Yep, that's right.
Perfect. And now, do you want to cover why they're so bad from a tax perspective, or you want me to take that?
Yeah, if you want, yeah.
Okay.
Go ahead.
Passive foreign investment companies are like every 4-letter word. Sometimes fun, but usually not. So, passive foreign investment companies will lead you down a path of US taxation that will be unfortunately relatively significant. There are different ways to treat a passive foreign investment company on a US tax return, but I'll cover the simplest one, which is basically the tax treatment. You buy a PFIC today, you sell it 10 years down the road. The US taxation, they do not want you to invest in mutual funds or ETFs outside of Wall Street. So therefore, they have punitive taxation, meaning you will be taxed at the top marginal rate for each year. So buy it today, sell it in 10 years. You have a gain of $100. That $100 gets ratably allocated over the 10 years. Each year's tranche has taxation at the top marginal rate. So currently 37%. So you may be in a 0% tax bracket and have PFICs, you will still pay 37% on that gain. And to make matters worse, or to add to the fun, they hit you with interest, compound interest, back from the time you purchased it. So you may wind up with a $100 gain, you may wind up paying $40, $45, $50 of taxes. you will wave your fist at me and say, my Lord, Jonathan, how is this possible? And I will say it's all due to the most dangerous man or woman in France, the French banker. Okay. So Cédric, how do you guys help clients avoid PFICs?
Yeah, one thing we can avoid it is by investing in the US with US custodians. And then we can invest, in investments that are either individual securities, then you don't have that issue, or investing in US ETF. That's the main way that we can help our clients avoid these mistakes. Yeah.
Awesome. Brian, Eric, anything you guys want to add?
So, in summation, your mother wouldn't let you use 4-letter words, and your tax accountant shouldn't let you use 4-letter acronyms. So that is our real takeaway with PFICs. I'm going to add one extra little disclaimer on there. It was said, but subtly in there. If we buy exchange-traded funds that trade outside of the United States, they are considered PFICs. Mm-hmm. So don't think that just because you bought the S&P 500 on, say, the Frankfurt Stock Exchange that you're safe. Now, everything you need to buy has to be on that U.S. stock exchange in some way, shape, or form to avoid being a PFIC in that regard. We also have 4 different platforms that we utilize on the U.S. side to be able to take care of these types of situations. And one of them is actually not held in the U.S., but adheres to all the U.S. rules just in case you're trying to get your money out of the U.S. Avoids having PFICs. So different situations for different, different things that we can utilize for different situations. Which one to use, just like Jonathan's rule, it depends. It depends on your situation. And Cédric and Eric can help you find the
glass of water.
Additionally, the other advantage of using investments in the US, and I'm just going to turn back for a second. The bee's knees for American retirees is when you have US sourced investment income. So by using US investments, you avoid PFICs, which have punitive taxation, and you also benefit from the US French tax treaty and the bee's knees tax treatment. Okay, so let's continue. IRA contributions in France, and Brian loves that I talk about IRA contributions because he wants everybody and their grandmother to understand one thing. Roth IRAs are Roth is a good 4-letter word. A very good 4-letter word, and something that everybody...
It's not a word, it's a name. It's named after the congressman that put it there.
Okay, sorry.
Sorry, Jonathan. There's not many times I get to correct you, so I'm going to jump on it.
Fair enough. Roth is a good 4-letter name, and it is the best way to save for retirement. Because you have to remember, as a U.S. individual living in France, you're going to pay next to no French taxes. If you're working in France, you may pay taxes in France, but not in America. So doing a Roth conversion and adding Roth conversions into your strategy is great, A, for your taxes, but B, for your long-term growth strategy to ensure that you are properly planning for retirement. Okay, so if you are thinking of doing IRA contributions, there are certain limits, 7,000 or 8,000, depending on your age. There are various questions that need to be looked at in terms of how we file your tax returns. You cannot simply just go in and file with a foreign earned income exclusion. You may likely need to take a foreign tax credit, take the foreign tax credit route. So again, these are questions that you should be having a conversation with your tax advisor and your financial advisor together in lockstep. I could tell you, Brian and his team, they reached out to me 3 times last week for joint clients saying, hey, we want to do Roth conversions for Bob Smith, Joan Smith, and Philly Smith. Well, we're working through how to do it properly for them, okay? Working in lockstep is the key. Cédric sent me a client the other day saying, hey, by the way, don't forget foreign tax credit. I said, yep, Cédric, won't forget that one. But again, working in lockstep, financial advisor, tax advisor together is the key. Cédric, anything you want to add?
Yeah, I mean, it's important for people to know that there's a difference between contribution and conversions, because obviously if you're a retiree, you don't have earned income in the US, you might not be able to contribute, but you can still convert. So that, I think that's the main thing to focus on.
Perfect. Awesome. Brian, anything else?
Just a quick question to redefine it. Can you just give us a quick summation of the difference between the FEIE and the tax credit, Jonathan?
Absolutely. The foreign earned income exclusion is a straight off the top exclusion or deduction of your income. So if you earn up to $130,000 outside of the United States in 2025, the first $130,000 straight off the top tax-free. Meaning if you earn $70,000 and you take this foreign earned income exclusion, you will have no income because it's $70,000 deduction, no income, no tax. In order to benefit from the foreign earned income exclusion, you have to meet one of two time-based tests. One is called the bona fide residence test, which says that you're a bona fide resident of a foreign country for one full calendar year. So Bob Smith moves to France today and he wants to meet this bona fide residence test, January 1st, 2026 till December 31st, 2026. So Bob Smith's 25 tax return would only be filed in January of 27. The second one is called the physical presence test, which looks at how many days have you been outside of the US in a 365-day period. And you have to be out of the US for 330 days. Again, all this minutia is stuff that we handle for you, okay? You don't have to worry about it. Now, the foreign earned income exclusion, the problem with the foreign earned income exclusion when it comes to IRAs is that if you do not have taxable income, you can't contribute to an IRA. So that's why if you're working in France and you're making under that 130, you may want to go down the route of the foreign tax credit, which is a credit which is a credit against your French tax. So Bob Smith again makes 100,000. He has US tax on that of 20,000. Bob Smith pays taxes in France higher than 20,000. The US will give him a $20,000 credit. Therefore, he will pay no US taxes. So again, same answer, 0, 0. But in one case, Bob Smith can contribute to an IRA. In the second case, Bob cannot. So again, there are factors to look at.
It depends.
Of course it depends. And now also with the foreign earned income exclusion, there is one additional thing that you have to factor in. If you have children or are going to have children, you may not want to take the foreign earned income exclusion because the US has a child tax credit, a refundable child tax credit, which cannot be taken if you take the foreign earned income exclusion. So again, these are questions that you need to look at initially when you move over and have a conversation with your tax advisor to ensure that you and your situation, because again, everybody is special and everybody's facts and circumstances are different. So, I've had people who come to me and ask me, had conversations with them and I said, okay, I'm sorry to ask, but you're in your 30s. Are you guys going to have kids soon? And to which they nod their heads or to say, no, man, kids, whatever they say. So long story short, have a conversation. And there's reasons why we ask, in our initial take-on sessions, we want to get to know you. We want to understand you fully, okay? So we will ask you questions such as that, not because we're trying to pry, not because we're trying to be weird, but it's because we're trying to make sure that we have the right answer for you, okay?
I would essentially say that is the number one mistake that I see from other tax accountants other than you is they jump towards the foreign earned income exclusion just because it's the easiest way to file. And a lot of times it's so beneficial because you get to accumulate those tax credits over the course of years.
You can carry them over for 10 years. And, there are multiple tricks that we can do. There's multiple arrows in our quiver with regards to your taxes. It's, again, everything comes down to proper planning and having proper conversations up front or before things change, okay? having the conversations are the key. Okay, perfect. So let's quickly talk about proper conversations, folks. Proper conversations, and this is only here to let you know that you need to have a proper conversation with your American advisor if you are going to set up a French company. Far too often, I have folks coming in and saying, I just set up a French company. How cool am I? And I say, my friend, you are super cool. Let me tell you why your US tax return preparation bill is going to go from X to X plus a significant amount more. If you set up a foreign corporation outside of the United States, you may have an 5471, an 8865, an 8858 filing. Doesn't mean much, but I will tell you this much. Go find a US tax advisor in a bar, whisper into his or her ear, 5471, and you will see him or her jump. So, again, if you see
That's my problem. Okay. These are my problems.
these things happen, Adrian. I'm telling you, my kids walk into my office sometimes just to freak me out. And my son Arthur comes in and goes, "Hey, Daddy." I turn around and go, "What? 5471." And oh my Lord, I nearly keel over. Thank goodness I'm trying to lose weight, or else I'd have a heart attack one of these days. 5471s. A colleague of mine gave a presentation a few years ago, and he said, I'm going to call this Form 5471, how to prepare the worst form in the world, because it's terrible. So if you set up a French corporation or a corporation in France, have a conversation. There are ways to mitigate the tax compliance and the additional tax costs that you will have, but it's imperative to have the conversation ahead of time.
Jonathan, whenever I have a client who thinks that they're going to come here and open some sort of business, I'm like, no, you don't want to do that.
Well,
not if you can help it. No.
Especially because in France, they have something called the micro entrepreneur status, which allows you to take a haircut on your income depending on what you're selling. And it works. You wind up paying almost as much tax in the US as in France as in the US. So long story short, proper planning ahead of time. Do not run off and set up an SARL, an SAS, because you think it's going to look cool on a business card and you're going to be able to pick up girls easier. A much easier trick is to say, I save money in my taxes. I don't pay as much in taxes. I'm telling you, chicks dig that. So, funny story about chicks dig that. My neighbors have chickens. They gave him a chicken for his birthday. He called his chicken Chicks Dig the Long Ball. So now he runs around screaming Chicks Dig the Long Ball all the time. So sorry, that's just an aside that I thought was funny just to add. I mean, how many tax professionals talk about chicks digging the long ball?
Hopefully none.
Oh, Adrian, you've got to see Chicks Dig the Long Ball. He's getting big and fat. So the next question we get asked very often is, what happens if I get an inheritance in France? Or if I get a gift in France? Do I have to file a tax return in France? And the answer is, folks, yup. So, and this is just, I'm going short and sweet on this. If you receive a gift from a non-US resident, a non-US citizen, if you make a gift to a French tax resident, as a French tax resident, if you receive an inheritance as a French tax resident, there are various filing requirements that you have, okay? So Brian was telling me the story the other day of how he went yachting. He found a man on the seaside. He helped him up. He gave him a beer. The man said, "Thank you very much, Brian. Here is a $200,000 watch." Because that's the kind of stuff that happens to Brian. If anybody ever knows anyone luckier than Brian, I don't. Okay? Well, besides the fact that he's friends
Did that really happen? That did not really happen.
It could happen to Brian, but you never know. Lots of good things happen to Brian. So, if someone wanted to give Brian a $200,000 gift, Brian would have a US filing requirement on Form 3520. If Adrian wanted to gift me over €1,500, Adrian would have a French gift tax filing requirement. If Adrian gifts me over $18,000, just double checking to make sure I didn't get last year's number. Yep, $19,000 this year. Over $19,000, she has to file a U.S. gift tax return. And last but not least, if Cédric receives an inheritance, even if it's an inheritance from a U.S. person, Cédric will have to file a French inheritance tax return. So why am I
And it's
sharing all this?
share, very share. in France.
Beaucoup cher. And
Uh-huh.
French inheritance tax returns need to be filed for a simple reason. If you receive an inheritance from a U.S. person, you more likely than not, and again, more likely than not, will not pay any French inheritance tax on it due to the French inheritance and estate tax treaty. Okay, again, all the tax treaties for Americans are the bee's knees. However, you will have to file an inheritance tax return. And an inheritance tax return can only be done with a notary or a French attorney. And if there are French real estate involved, it has to be with a notary. And anyone who knows a notary in France knows that notaries are forced to charge based on a governmental tariff rate, and it's expensive. So if you have any questions or need any help, please reach out on these questions. I just want to make it clear that these may have implications and they may be severe. So just take note.
Well,
John. Yes, ma'am.
No, I was just going to say, as you know, the inheritance tax situation is a big topic. I mean, it's something I cover with my clients almost constantly. And one of the things that I'm always advising is that the people who are purchasing property, especially for retirees, they're older, 60 years old plus, and they have kids, that they should consider purchasing the property in their kids' names so that the kids can inherit the property tax-free, because the inheritance taxes are so expensive. And it's a great way of getting some of their assets over to their children in a totally tax-free way, which is something I'm doing myself now.
Yeah. And again, this all requires proper planning ahead of time. And it's one of the reasons why, you know, if you have any questions, you reach out to us, you reach out to Adrian, we will help you. We will, both Adrian and myself will point you probably towards Carol and Nice, but basically we will help you ensure that you're setting yourself up for success on, especially when it comes to a real estate purchase, because there are a multitude of ways to do it. Besides buying in your children's name, you can use something called démembrement, which again is above and beyond the subject in this conversation, but you can use something called démembrement, which I like to tell people to use because, hey, you never know if your kids are going to marry a bad wife and lead to family strife and want to kick you out of the house. So you're probably better off using the démembrement because they can't kick you out of the house. You never. I've got 3 boys. One of them is going to marry somebody that doesn't like me. I don't know how it's going to be possible, but one of them is going to. So it's gonna lead to problems. Well, again, knock on wood that it doesn't. But anywho, long story short, proper planning ahead of time, or if you're going to make a gift, receive a gift, or receive an inheritance, have a conversation because there are various filings. Okay.
Okay, Jonathan, we're down to about 15 minutes
Perfect.
remaining, and I want to have enough time for the Q&A.
Perfect. But Adrian, this is it, Adrian. This is the bad news. This is the slide. This is the slide where we take all our happy smiles and the bee's knees, and we tell Americans one specific thing. France does not trust trusts. They do not. So, what does that mean? If you are the trustee, the beneficiary, or the settlor of a trust, a conversation needs to be had before you come to France. There are 2 trust filing requirements if you have a trust. One is an annual filing requirement where you have to say, hey, these are all the assets I have in the trust. Another is something called an event filing, which is basically anytime you put money in or out of the trust, you have to do an event filing. Okay, those are filings. We can help you. We have an attorney that works with us, Vincent, who can assist with these filings, and he's great, and we can make it as easy as pie. However, folks, the French courts have come in and have made a little bit of a mess on this in the past year or two. And this is important for you to understand. Trusts are not the bee's knees. They are as opposite. They are a wasp's knees. And the reason that they are not the bee's knees is that the French High Court was asked a question by the French tax authorities about 2 years ago. The question was relatively simple. Should we treat revocable living trusts for Americans the same as the US does? And the answer was no. No, no, no. The answer was a trust is a separate entity from the person who sets it up, and therefore, even if it's an American person who set up a trust, has income from the trust, they cannot benefit from the tax treaty. Meaning, and one other thing, France only taxes trusts income when you distribute it. So Bob Smith has $100,000 distribution out of his trust in a year. France will want to tax the portion of that that's income. Okay? It is relatively complicated. It is relatively cumbersome. But basically what it means is if you're going to distribute money out of your trust annually in France, you may be subject to double taxation. And get this, the tax high court has said, well, we're not going to give a credit. It's up to America to give the tax credit. Good luck telling the IRS that your US investment income or dividend distributions from a trust are French sourced income. It's not going to be very easy. And to make matters even worse, there was a recent court decision where basically the client tried to argue that he took out principal from his trust and not income. And the High Court came back, the High Court or the Appeals Court, sorry, in this case, came back and said, no, any distribution from a trust is considered income and therefore taxable unless you can prove otherwise by accounting. And again, good luck finding an American trustee who can prove this. Basically, folks, France does not trust trusts. They are the wasp's knees. So you need to have proper planning ahead of time.
The good news, though, Jonathan, is that most trusts, I'd say over 90% of trusts, are revocable trusts, family trusts in the United States that essentially are built to avoid probate on the US side of things. So by the time you move to France, if you take the money out of the trust and put it back into single name, you're not in a detrimental position. It was a great estate planning tool while you were in the US, but it's not going to change your situation significantly once you get to France. Correct?
Yeah. But again, proper planning and a conversation before you come is imperative. Because too often people come to France and they have multiple trusts and they have multiple distributions, and it is leading you down a path of issues. So again, sorry to end on a sour note, but trusts need to be carefully looked at. And yes, revocable trusts can be revoked. You can take the assets out, but have a proper plan before you come. Okay. Now, with that, as Adrian said, people have lots of questions for Cédric and Brian. They don't really have questions for me, I'm sure, because I was just super clear and nothing else. There's nothing else really interesting in taxes. So, sorry. So, Patty, what do we have?
Patty, wake up.
I turned, oh, sorry. I'm here. Jonathan, I'm going to start with some questions for you.
Shoot.
Don't you love it? We have several questions from people who are working remotely, living in France and working remotely.
I saw that.
About when they become tax resident in France and how this all affects them being not retirees.
And Buck says it depends.
It depends.
There you go. It depends. If you're a remote worker in France, a conversation should be had with a tax professional to ensure that your situation is treated with the care and love that is necessary for your situation. But it depends.
Thank you, Jonathan. I have another tax question for Jonathan. This is from Carol. I currently live in a high income tax state, California. I plan to be living in France by the end of 2025. Is it worth moving my domicile to a no income tax state, even if only briefly?
This is one that Brian and I had a back and forth on the other day. And the answer that Brian will give, and I actually don't disagree with Brian, so I'll give Brian's answer. Brian's answer is if you keep your bank accounts in California and your addresses in California, there is a chance that you will get a notice from California asking for a tax return. So poor Brian here, who used to live in California, he got $10 of interest one year on a 1099, and California asked him for a California tax return. California is a sticky state. So the answer is it probably doesn't hurt. It's not absolutely necessary, but it probably doesn't hurt.
I'm going to add to that, Jonathan. The silliest mistake is to have a big 1099 go to that state after you live there, i.e., you use a friend's address in California, you've moved to France, then all of a sudden they send you a bill for $100,000, and you're having to argue quite extensively to say, yes, I've got a 1099 that says I live in California, but I actually don't live there.
Yeah.
A lot of our clients will move to a state that is not only non-taxable, but a state that has the driving license reciprocation, so they can also get the driving license and benefit from the, the no tax state as well. Florida, for example, is one of them. Right.
Plus, we could use a few extra voters in Florida.
You mean on the side we want them to be on?
We'll leave it at that.
Okay, we've got 5 minutes. Patty, find us another good question.
Okay, now I got to find another good one. I thought I had one for Brian.
There was one that was asking, do you need to have a French financial advisor? So I'll jump on that one.
Yes, that's a good one. Yes.
So here's one thing that I find is so important. Essentially, if you leave your money with your American financial advisor, you're probably the only client that they're dealing with that's cross-border or cross-border with France. By dealing with a firm, Eric and Cédric, all of their clients are Americans that live in France. That means you're the norm for them. When you're asking them questions about the double taxation treaty, they're not looking for it. They know it back to front. So when we're talking about PFICs, it's not how does that work and how does that operate? We have Jonathan on speed dial. Sometimes I think he wants to block me, but we do have him on speed dial. So we're having those constant conversations and we're working with all the professionals. It's the typical type of client for us. So yes, I do recommend having a financial advisor that deals with Americans in France because we know your issues.
I agree with you on that, Brian, completely.
They are American.
No. I mean, I see that there are a lot of financial advisors that claim to be international, but the truth is they don't really understand what that means. Not fully. So,
Absolutely.
Okay. Patty?
I know, I'm trying to find the next question. This is maybe one for Jonathan, but it comes up from time to time. What is the situation for a French-US couple in FATCA? Are the French member investments in France taxed in the US?
So whenever we have a dual national couple, we always recommend, well, again, it depends. But if it's a US person with a French partner, the French partner, as long as the French partner is not a green card holder, a citizen, or has made an election to be treated as a U.S. taxpayer,
Mhm.
that person's investments are not included on the U.S. tax return. Therefore, we generally recommend that the bank accounts stay segregated and separated between U.S. partner and foreign partner. That way, foreign partner can go off and invest in whatever he or she wants. U.S. partner, avoiding PFICs, invests in the U.S. investments. So to answer your question is, it depends. Now, in a case where a lot of people have partner one and partner two, they have a joint account for their mortgage. Well, that bank account has to get reported on your FBAR and your 8938, because any account that a U.S. person has signatory authority over will be reported to the U.S. government. But any account that doesn't have a U.S. person, U.S. government does not need to know about it.
Thank you, Jonathan.
I think we've pretty much answered most of the questions.
Yeah, I was just typing an answer to somebody.
Okay.
Oh, then here's another tax question for Jonathan, though. I'm a dual citizen. Do I still have to file a French tax return even if I'm retired?
Yeah. Citizenship doesn't matter. If
Yeah.
you're a U.S. citizen, French citizen, it doesn't matter. The bee's knees for American retirees applies if you're a U.S. citizen. So if you're a U.S. citizen and a French citizen, cool, you get to go in the faster line at the airport, but it does not change your tax answer.
And you have to file a U.S. return
You have to file a
regardless
U.S. return as
for
well.
the
Yes,
rest
ma'am.
of your life, no matter
Yep.
where you've earned your money.
Yep.
Mm-hmm.
But
Right.
again, filing a U.S. tax return and benefiting from the deemed tax credit on the French side is a win, people. It is a definite win for Americans living in France. You pay tax to America. The American tax is 15% on qualified dividends. The tax in France is 30%. I'm not a really good at math, but I think 15 is less than 30. So therefore you are better served paying your tax to America and filing a U.S. tax return, because you will benefit from this treaty.
Well, Jonathan and Brian, we're now at 8 o'clock, so our session is over. Do you have any final words you'd like to say before we say goodnight or goodbye?
Well, I just want to thank everybody for participating tonight. I really enjoyed it, and thanks for the questions. And if you have any questions, please do not hesitate to reach out to us at hello@hadtax.com. We are here for you to help you in all your French tax needs. And yes, we are, and I'm sure Brian, who's not on camera right now, is very excited to have Eric and Cédric having joined over from Harrison Brooks recently. And I'm very excited to have Cédric working, because now Cédric working with Brian, because now it makes it cut down from my sending clients to 2 different places. It's now all to Cédric. So it's a huge win.
Okay, and let me just say that thank you to everyone who participated in this tonight, Brian and Cédric and Eric and Jonathan particularly, who really led the show, Patty for taking care of questions. Our next forum is on June 25th. So mark your calendar. We'll be promoting it through our newsletter, through Brian Dunhill's. And also, this has been recorded. We're going to post it on our YouTube channel so that you can send it off to your friends, watch it again if you want to. And I want to thank everybody, and we look forward to seeing you in June.